So we have a few ground rules for today. The first rule that we have is you should kindly mute your mics when someone is presenting. The other rule that we have is you should switch off your cameras so that we can avoid distractions. So today I've got three presenters from the ZSE and from the VFEX. So I think we can start with our first presenter. Our first presenter for the day is Mejuri Mapungwana. So Mejuri Mapungwana is a dynamic professional with a Bachelor of Technology, honors degree in financial engineering from Harare Institute of Technology. She kickstarted her career in the capital markets at the Securities and Exchange Commission of Zimbabwe, where she gained valuable insights and experience in regulatory frameworks and market operations. Mejuri went on to be part of the ZSE Markets team in the Trading and Market Data Department for 2 years. Currently, Mejuri serves as a dedicated team member in the business development at the Victoria Falls Stock Exchange, utilizing her expertise to navigate the complexities of the financial industry and contribute to the growth and development of the capital markets in Zimbabwe. So Mejuri is going to be our first presenter. And if you have any questions during her presentation, feel free to use the chat box and we can have a question and answer session after all the presenters are done. Thank you. Over to you, Mejuri.
Thank you, Ruby, for that. Thank you, everyone, for attending our webinar, where we're going to try as much as we can to exhaust the important stock market terminologies. Allow me to share my screen so that you can see the presentation as I go through it. Kindly confirm if anyone can see my screen. Can you see my screen?
I can see it from this side.
Yes, we can see your screen.
All right. Thank you so much. I think we can all agree that we will not be able to exhaust all the stock market terminologies in just today's session, but I think myself and my colleagues are going to try as much as we can to explain on the key terms that we think everyone who is interested in investing on the stock market should know and be aware of. So without wasting much of our time, my presentation is going to cover the following 4 aspects. I'm going to do a brief introduction on the Victoria Falls Stock Exchange and how it came to be. I'm then going to move on to try and explain some terminologies that are related to a listing. And I'm also going to talk a bit about the products that we do have and some terminologies around corporate actions. So the Victoria Falls Stock Exchange, as said by Rumbi earlier, I'm part of the business development team. The VFX is a subsidiary of the Zimbabwe Stock Exchange. It is wholly owned by the ZSE Holdings. So it was established in 2020 to kickstart the offshore financial service center in the Victoria Falls town. And currently, the exchange has a total of 16 listings since inception in 2020. So some of the products that we do have on the exchange, we have one bond, the Karo Mining bond that is listed. We have 3 depository receipts, that's Nedbank, Caledonia, and Invictus Energy. Then we have 12 equity instruments. So the currency that's used to trade on the Victoria Falls Stock Exchange is strictly USD. and anyone can invest, local investors, foreign investors. As long as you have your USD, you can open an account and start trading. So the general functions of the exchange, capital raising. So we assist companies who want to raise capital. It can be for expansion or carrying out different projects. Then after these companies have managed to raise the capital that they want, we ensure that there is a fair and orderly market. And we are also responsible for dissemination of information that might relate to stock prices and any other material information that has influence on the performance of the listed companies. So moving on to the terminologies, starting with the ones that relate to a listing. I think the first thing that I thought was important for me to explain is what we call a stock exchange. So a stock exchange is an organized market for sale and purchase of securities, such as shares, stocks, and all the other ones that I have mentioned earlier that are on our exchange. So when we say a market is organized, it means that it is governed by certain rules and regulations. And it is a good thing for investors to know that when they are trading through a stock exchange, they are trading on a market that has rules, regulations, and these are in place ultimately to protect the investor. So it's different from when you're trading over the counter. There's no one who is jurisdiction over that. And when you're trading through a stock exchange, you're protected as an investor. So um, what we call a listing is the formal admission of securities of a company on the trading platform. So whenever a company wants to list on our exchange, they have to adhere to certain requirements that are specified in our listing requirements and listing rules. So it depends with the kind of security that they want to list. And once they have conformed to all the minimum requirements that are there, then through the listings committee, that is our board of directors, they have to make sure that everything is in order, and they then do the formal admission of the company or any security to list on our exchange. So usually when a company lists, this is publicized information, and it is marked by a listing ceremony, and we make sure that we inform the investing public that we have admitted this new issuer as a listed company or security on our exchange. So whenever you want to know any information about new listings, it's available on our social media platforms, our website, and probably the websites of the issuers. So when a company lists and they want to raise funds, the very first time that a company issued these securities and they raise funds, they do it on what we call a primary market. So a primary market is when new securities are issued and sold for the very first time. So the primary market is usually a once-off thing, and when the company manages to raise the funds that they want, these securities now do the day-to-day trading on our exchange. And this is what happens now on the secondary market after the issuers have managed to raise the money that they want on the primary market. So from what I've just explained, you can see from the definition on the screen that a secondary market is where already issued securities are bought and sold by investors. So this is now the day-to-day trading where you can open an account, you can buy securities today, you can sell them tomorrow, just to create liquidity and flexibility for the shareholders if they want to get into a security or get out of it. So related to what I previously explained is what we call an IPO, an initial public offering. This happens on the primary market. So it's a process by which a privately owned company issues its shares to the public for the very first time. So in IPO, I think the most recent ones that we've had in the past year or two is on VFX, we have West Properties, and on the Zimbabwe Stock Exchange, it was mainly the REITs. We had the Tigere REIT and the Reviters. So that process where they issue these shares and raise money from the public for the very first time is what we call an initial public offering. Also related to listing, there is what we call a dual listing. So it is when a particular security is listed on more than one exchange. So a company might decide for any of the reasons that might include raising money from a foreign country that is foreign investment, or just increasing their exposure to other markets. A company might decide to list on another exchange apart from the one that they have their primary listing. So when a company is listed on 2 or more exchanges, we refer to that company as a dual listed company. So on Victoria Falls Stock Exchange, we have Seedco International Limited. It has its primary listing on the Botswana Stock Exchange, and it's also listed on VFEX. So this is what we refer to as dual listed companies. One key document that I thought was important to mention is a prospectus. And this is issued by a company when it seeks to raise funds from the public for the very first time on a stock exchange. So the prospectus is a disclosure document that provides details about an investment offering sale to the public. So a prospectus, it has information that it has to have that is sufficient enough for the investor to know what they need to know about the company. So these stipulations are outlined in Statutory Instrument 134 of 2019. So it clearly outlines what the issuers have to include in that document. And that information was in place, and we thought that that would be enough information for an investor to make an informed decision on whether they want to invest in this instrument or not. So I think it's important for investors to read these documents when they come out. It gives you an exhaustive explanation of what the company is all about, projects that they are carrying out, and probably future prospects that they do have in terms of developing the company. And it helps the investor make an informed decision on whether they want to buy the security or not. And usually this document is usually available at the issuer's company or their sponsor for further interpretation. If maybe you do not understand what's in there, you can visit their offices. They would have those documents usually in hard copy, and they can give a further explanation if you have any inquiries that you do have about the company. So moving on from the listing terminologies, I will just speak a bit on the products that we have. So there's the term equity, which is simply the value of an investor's stake in a company. So when you say you have equity in a company, it means you have some ownership in that company. So equity just relates to the value that you have in that company as a shareholder. And under the equity instruments, we have ordinary shares. I think these ones are straightforward. They're also known as common shares. And they've certain rights that they do carry with them. For example, you have the right to vote. You can get income from dividends on the corporation's profits. And ordinary shares, I think they are just as I have alluded to, they are straightforward, plain vanilla, and there is nothing complicated about that. When you buy a share, you are part owner of the company. Then we have depository receipts. This is an instrument that represents an interest or a shareholding in a company that is listed elsewhere. So like I said, when I was starting my presentation, I think I mentioned about 3 depository receipts that we do have on the Victoria Falls Stock Exchange. So when you buy that unit of the depository receipts, it means it represents an interest in shares that are listed, or in shares of that company that are listed on another exchange. The other products that we do have, we have an exchange traded fund. which is a basket of securities that tracks or seeks to outperform an underlying index. So with exchange traded funds, it's a pool of securities, and they usually follow a certain theme, or yeah, probably a certain theme. For example, we have some that are pooled in terms of their market size. Some are because of the sector that they are trading in. For example, on ZSU, you have the Old Mutual Top 10. This one, it tracks the performance of the top 10 in terms of market capitalization of companies that are listed on the ZSE. Then, for example, we have the Casado agricultural ETF index. So this one tracks companies that are in the agricultural sector. So ETFs have different themes or a basket of securities that have common features that it tracks. So when it says it seeks to outperform an underlying index, it means that as an ETF, when they are pulled together, they're then consolidated into units that represent interest in all those underlying assets individually. So an ETF now, when it says it seeks to outperform an underlying index, it means that it needs to have more value than the individual underlying stocks, which means that it will be trading at a premium. So that's what an ETF seeks to achieve, to outperform the individual underlying stocks. Then we have the real estate investment trusts, and they also trade like stocks, and it usually owns and operates income producing real estate. Currently on the ZSE, we have two of those. So a REIT for a REIT to come by, it can follow quite a number of ways. For example, a REIT can already own assets, and what they just need to do, probably they want to expand or develop more real estate assets. They then raise funds, and they distribute the income from the asset that they already own, and distribute the income to the unit holders. Also, a REIT can probably, if it doesn't have assets as of yet, it can raise funds, then it purchases the real estate assets under it, and then it can distribute income from those assets to the unit holders. A REIT can also raise funds, then develop the properties, and then distribute the income to the unit holders. And it can also do all these things concurrently. For example, we have the Revitas REIT. It has assets that are already income generating. At the same time, they are renovating and repurposing other assets that they have under that REIT. So they can have some assets that are already income generating, and others that need to be developed or revamped or renovated. One other product that we do have is a bond. Bonds are issued by governments and corporates when they want to raise money. So unlike stocks, the equity instruments that I have explained previously, a bond does not give you ownership rights to the company. So in a way, you are a creditor of the company. They owe you some money, and you do not have any part ownership to that company. So it represents a loan from the buyer, which is you, the investor who has bought the bond, to the issuer of the bond. So the bond issuer is the one who owes the buyer of the bond. So bonds, they have periodic payments that they do pay out that are called coupons. So coupon payment periods can vary from bond to bond. Some are paid quarterly, some are paid biannually, and these periodic payments are paid up until the expiration or maturity time of the bond, where the principal amount that you have invested in the bond or you have bought the bond for, you are then given at the time of maturity. So on VFEX, we have one bond, which is the Karo Mining bond. It is a 3-year bond, and it expires in 2025. Yes. So I think that's it on bonds and the securities that we do have listed on our exchange. Moving on to terms that relate to corporate actions by the listed companies. So probably just explaining what a corporate action is. So these are actions that are instituted by companies, usually through their board of directors, and they have material effect on the company or its shareholders. So it's mandatory for them to disclose to the investing public if there is any such actions that they might want to carry out that have material effect on the shareholders, be it the share price or the operations of the company. So they have to issue out this cautionary statement. So a cautionary statement can include statements relating to future actions, prospective products or product approvals, future performance of results, anticipated products, the outcome of contingencies such as legal proceedings, dividend payments, and financial results. So it is important for an investor to track these cautionary statements by the companies that you are invested in, because it gives you insights on actions that might want to be taken by the company that will have an effect on your investment. So you have to really follow this. And if you have any queries or information that you might want clarity, you can consult your asset managers, your investment advisors, your stockbrokers, or the issuer themselves to get more clarity on what this cautionary statement that you'd have seen might entail, or how it might affect your investment. So some of the corporate actions, the ones that have happened recently, I think it was last year, we had quite a couple of rights offers. So a rights offer occurs when a company offers its existing shareholders the opportunity to buy additional securities. Um, so when a company wants to raise money, it can be for expansion or any other reason that the company does disclose when they are informing their shareholders about this rights offer. And if they do not have the intention of diluting existing share ownership, they give an opportunity to the existing shareholders to follow these rights by buying new securities. And rights offers are usually at a discount. So you get an opportunity. Let's say your share is going for $1 right now. They usually maybe offer it at probably 90 cents. So there's a ratio that they do disclose to say if you have one share, probably you have the right to follow on one share as well. Or so it means that if you have a total of 1,000 shares, you can buy 1,000 more shares at a discount. And like I said, I think last year we had quite a couple of these. We had Econet, we had EcoCash, Turno, and Truworth. So these are some of the companies that issued rights that offered rights to their existing shareholders. And whenever you don't follow your rights, it means that you are probably risking the dilution of your ownership, because it simply means that if you with your current 1,000 shares, if you were owning 5% of the company, if now a new shareholder comes and takes out your rights, it means that your total share ownership of the company now has significantly reduced from the 5% to probably 3% or whatever percent, depending on the total shares in issue of the company. So it's important for you to also follow your rights if funds permit, so that you don't risk diluting the ownership of your stake in the company. So there's also what you call a share split and a reverse share split, which is the opposite of a share split. So when a company probably trying to maybe conform to certain regulations in terms of shares that they have issued, a company might choose to split its shares by dividing its stock into multiple shares, effectively lowering the price of each share without changing the company's market value. So it simply means that if a company is worth $1,000 and each share was worth $1, when they split, probably there's also a ratio that they do use to split. And let's say, for example, they've split to say if you have, for every one share that you were holding, you now have 2 shares. It effectively means that if your one share was worth $1, it means that for that one share, if you've got 2 shares now, it means each share is now worth 50 cents. So it effectively lowers the price of each share, but it doesn't change the company's market value, and ultimately does not change your value's worth or your equity's worth in that company. So it just means that your shares have increased in number, but they've not increased in value. So a reverse share split is the opposite of a share split. It means that they will be consolidating now the shares, and effectively it increases the value of each share. So taking the example that I gave previously, if your share was worth 50 cents, and for every share that you had is being every 2 shares you have, they are consolidated into one. It means your one share is now worth $1. So I think another corporate action that is usually common is a share buyback. So for some reason, companies usually have a certain percentage of the company stake that they have for themselves. So sometimes when they need to raise money, they choose to sell these shares to the public. Probably they want to carry out a project, or they want to expand, or for whatever reason, they sell these shares to the public, right? And they raise this money. And now probably the project is running, it's now giving them back money. They might want to go back to maintain the level of stake that they had in the company. So they go back to the market and they buy back the shares. So this is what we refer to as a share buyback. It's when a company buys shares of its own stock on an open market from the investing public. And also sometimes where a share buyback can happen is when a company seeks to delist, they usually they are supposed to do a mandatory offer where they buy back shares from the investing public before they do delist. So that's some of the times where a share buyback can happen, when a company buys back its own stake on an open market from the investing public. And another corporate action is unbundling. Unbundling occurs when a company sells off lines of their business, including assets, subsidiaries, etc. So in this process, it completely separates income from the parent company, and this subsidiary is now a standalone company. So I think a perfect example of when unbundling happened on the Zimbabwe Stock Exchange is the case of Econet. So they had their subsidiary Cassava Smart Tech that unbundled from Econet, and it was now a standalone company. It is its own separate income, and it's acting in its own accord as a separate subsidiary from the parent company. Cassava, now known as EcoCash Holdings Limited. So these are some of the corporate actions that we have seen happen on our market, and which I thought that investors should be able to understand and have a clearer view on what will really be happening when these corporate actions do happen. And I think if they, like I said before, we cannot exhaust all the terms, and I have to leave time for my other colleagues to talk about other terms as they relate to trading and settlement of trades. So anyone who has questions, like Ruby said, you can post them on the chat box. And once everyone has finished with their presentations, we can revisit them and give clarity. So thank you very much for taking time to listen to me. And over to you, Rumbizai.
I think we can all agree that that was a very informative presentation from Medju. Thank you so much. I think we can move on to the next presenter. Our next presenter for the day is going to be Takudzwa Zhou. So Takudzwa is a member of the ZSE Markets team at the Zimbabwe Stock Exchange. He holds a bachelor's degree in actuarial science from the University of Zimbabwe and has been with the exchange for over a year. In his role, he has made significant contributions to the growth of the ZSE He actively identifies and develops new business opportunities, manages market data services, facilitates trading, and plays a key role in investor education. Takuzo has also passed the CFA Level 1 exam and is currently pursuing the Registered Persons Examination from the South Africa Institute of Financial Markets, having successfully completed 2 of these exams. Over to you, Takuzo, for the presentation.
Thank you so much, Rumbi, for the introduction. Thank you so much, everyone, for joining our webinar. Allow me to share my screen as I begin my presentation. Kindly confirm if you can see my screen.
Yes, confirmed.
Yes, we can see it.
Okay. Thank you so much, Rumbi, for the introduction. My name is Takuzwa, and I'll be taking you through the stock market terminologies, continuing from where Majuri left off. I will be continuing and touching mostly on the trading aspects of the stock market terminologies that we are going to be covering in this webinar. So, as Majuri has highlighted, we cannot exhaust all the terminologies that are involved in the stock market, but rather we will try as much as possible to make sure that we highlight all the key concepts and all the key terminologies that are involved in the trading, settlement, and all the basics of trading and stock market terminologies that we are going to be covering today. So, as an introduction of my presentation, this is just the basic overview of what I will be touching on in this webinar. And one of the key things is the introduction. I'll be introducing the Zimbabwe Stock Exchange as a whole, touching on the legislation that governs the Zimbabwe Stock Exchange, as well as the products and services that are offered by the exchange, the trading sessions that we have on the exchange, as well as order types. Then after that, we are going to touch on order attributes. And these involve your time in force as well as order qualifiers that are available when you are trading in financial securities. After this, we are going to be touching on the time in force attribute as well as tick sizes and the price spread that is allowable when you are trading in securities on the exchange. Finally, I will touch on the matching criteria and then the indices and market capitalization as a whole. Then I will also just give a brief background of the statutory costs that are involved when you're trading on the Zimbabwe Stock Exchange as well as the Victoria Falls Stock Exchange. So as an introduction, the Zimbabwe Stock Exchange, it is a licensed securities and exchange in terms of the Securities and Exchange Act. We are governed by the Securities and Exchange Act, and this is administered by the Securities and Exchange Commission, which is the regulator of all the market players in the capital markets industry. Of their key roles is to make sure that the investor is always protected. Investor protection is one of their key roles, and to make sure that we are transparent and there is integrity in the markets. So one of the documents that guides us is the Securities and Exchange Act, and it is the principal document that governs how the exchange operates and how other key participants on the exchange will be able to handle their operations. We also have statutory instrument 100 of 2010, which is on the licensing and membership on the stock exchange. Then we also move on to the statutory instrument 134 of 2019, which touches on the listing requirements for all the listed entities on the exchange. So when you are an issuer coming on the exchange, there are certain rules and regulations that you have to abide with for you to be able to be onboarded on the exchange. So this document gives an outline of all the rules and regulations, the continuing obligations, as well as it also gives power to the exchange to do certain things if there is an issuer that is not compliant with the rules that are set in this document. So principally, all these documents, what they are trying to accomplish or what they're trying to do is to protect the investors and protect the end users of the financial securities to make sure that they are always protected. And because of information asymmetry, no one is going to take advantage of the other person. So this legislation, it makes sure that everyone is properly regulated and there is transparency and integrity in the market. In terms of the services that are offered by the exchange, the first and foremost one we have is trading, and I'll be touching most on this one. So when it comes to trading, I think as Marjorie has said before, we have two aspects, which are the primary and secondary market. So the primary market is where initially issued, just as was said earlier. So now the trading aspect of it, after securities have been issued for the first time for investors, these investors can now participate in the trading, which is the exchange of these securities, buying and selling financial securities on a regulated platform. So the exchange offers you the platform for you to be able to buy and sell securities that were previously had transactions in the primary market. Then we move on to market data services. So we are also responsible for the distribution and compilation of market data to all the key participants or key stakeholders in the industry. And this data is very useful for research purposes and educational purposes for all interested parties. We also have depository services. I will not touch on depository services. I think Marshall is going to touch more on this one, and he's going to demystify all the areas that might be confusing for now. I think he's going to touch more on this one. And we also have issuer regulation services. So on issuer regulation now, we are saying, as I said earlier, that we have SI 134 of 2019, which which outlines all the listing requirements and continuing obligations of entities that are listed on the exchange. So the issuer regulations now, we are making sure that all the entities or all the companies that are onboarded on the exchange, they are continually complying with the rules and regulations that are outlined in the SI 134 of 2019. Then we also have training services, mainly through the ZSC Training Institute. You can have access to the ZSC Training Institute through our website. And what it does, it tries to educate the investors to make sure that everyone is well equipped and everyone understands the dynamics of the capital markets, all the regulation that is involved, and all the aspects that are involved when you are dealing in securities. So this is one of the other key things that we try by all means to make sure that everyone is well educated and everyone is knowledgeable when it comes to to training. Moving on to our trading sessions. So the first one we have is the pre-open session, which runs from 9 a.m. in the morning to 9:30 a.m. So before I explain further on the pre-open session, it is very important for individuals or for investors to understand the difference between an order and a trade. So the major difference between an order and a trade, an order is a request made by a trader or by an investor to buy or sell securities at a specified price in a specified time range. So that's the basic definition of an order. And now, when we are defining a trade, we are saying this is when the actual execution has happened. This is now a transaction where you have actually bought the shares, and the shares are transferred to you, and you also pay the required price for that specific trade. So an order is just a request usually submitted to a broker to buy or sell securities. But when it comes to a trade, there is an actual execution, and following the trade, there will be the exchange of securities as well as the exchange of funds after the trade has been done. So in the pre-open session, what you are doing is you will be entering orders. You have the option to enter orders, amend them, or delete them before the market opens. So essentially, what the main purpose of this pre-open session is to make sure that there is proper price discovery as soon as the market is open. So there are no market orders when we are still in the pre-open session, but you can enter what we call limit orders. I'll be able to explain further on these ones. Then at 9:30 a.m. the market will be open. As soon as the market opens, the ATS will be able to calculate the opening price of the securities, and the market will be live, or the order book will then be live at that particular stage. So after the opening after the opening session, we now go on to the continuous session, which runs from 9:30 a.m. to 1 p.m. in the afternoon. So during this continuous session, this is when I was saying that the order book will be live, and new orders, they will be checked against existing orders in the order book, and the ATS will try to match all these orders until no further matching is available. After the continuous session, we then move on to the closing session, which is at 1 p.m. And this is when the ATS will then calculate the price, the closing price of all the securities. And if in the event that there are no trades for that particular security, or there is a security that did not manage to trade for that particular day, the closing price would default. It would default to the last day's closing price. So the ATS, what it will also do is it will assess, or it will process all order attributes to try and see if there are any orders that need to be expired, or if other orders will be rolled over to the next day during the close. And after the close session, we then go on to the post-close session, which runs from 1 p.m. After the close to 2:30 p.m. So during the post-close session, what we are doing is, this is where orders can be amended, deleted, or or cancelled. So you can cancel or amend your orders during the post-close session, and also you will be able to cancel or trade, or cancel or amend trades during the post-close session. So when it comes to cancellation of shares now, it requires a mutual agreement between the buyer of the security and the seller of the security as well. So the exchange also has to approve of this cancellation or amendment of a trade before it is before it is before it is enacted. So the corresponding parties have to seek approval first from the exchange, and then if they both agree on the cancellation or amendment of that trade, it will then be done in the post-close session. Moving on to the types of orders that we have. The first one is a market order, and the second one is a limit order. So when it comes to market orders, this is an order to buy or sell securities at the best available price in the market, or at the prices prevailing in the market at that point in time. So what the market order does is, you do not have to specify any particular price at which you want to buy or sell the securities that you are trading in, but you specify the volume or the number of securities that you are willing to buy or sell without really specifying the price. What the market order does is, it prioritizes execution, and it also has priority in the ATS, or the automated trading system. It takes priority over limit orders. So for example, as an investor, your end goal is to say, I want to buy these particular securities for, you do not have a specific price or a maximum price that you are willing to pay for that, but your priority is in buying those securities. A market order will be sufficient for you, and you'll be able to enter that market order specifying the volume of securities that you want to buy. When it comes to limit orders now, these limit orders, they specify the maximum buying price or minimum selling price of a security. So instead of unlike the market order, which takes priority of execution, the limit order, you are now more on the conservative side, looking at the price. So you are specifying the maximum price that you are willing to buy a security, or the minimum price that you are willing to sell the security for. You also have to indicate the volume the volume or the number of security that you are willing to buy or sell in that particular security. So as limit orders are entered into the order book, the ATS will also try to match all these orders with the existing orders in the order book until no further matching is available. And when no further matching is available, the, the the limit order will then remain in the order book, pending other orders to come through. Moving on to our order qualifiers. So what order qualifiers do is they modify the execution conditions of an order based on either volume, price, or time. So this is a modification of your order based on either volume, time, or price. So the two main order qualifiers that we have are the fill or queue order and the immediate or cancel order. So what the fill or queue order does is it executes the whole order, or it cancels it. So once you enter a fill or queue order into the order book, what it does is it tries to match the entire order. If the entire order cannot be matched at that particular time, that whole order is cancelled. It does not allow for partial matches, and it does not allow for partial matches on that particular trade. The other key aspect when dealing with these both these order qualifiers is to say they cannot be entered in the pre-open session. As I said earlier, that we have the pre-open session where you are entering your orders. So the fill or queue order and the immediate or cancel order, they cannot be entered in the pre-open session, but rather you can start entering these orders once the market is opened. We move on to the immediate or cancel order. So as its name suggests, it allows for partial matches. So when you are entering an immediate or cancel order, what it does is it matches the volume that is present in the market at that particular time, and the remainder that is not executed will immediately be cancelled. So unlike the fill or queue, which cancels the whole transaction if it cannot be completely executed, the immediate or cancel will just cancel that portion that is not executed at that particular time, and the rest that can be matched will be partially matched for that particular trade. We also have time in force. So time in force, in the basics of it is it limits the lifetime of an order in the order book. So when you're entering these orders, limit orders, they have you have an option to specify the time in which you want the order to last, or the time in which you want the order to expire in the order book. So the first one we have is a day order, and just as its name says, it's only valid for one day or for a single trading session. One of the other key things that have to be said is to say, when you are dealing when you do not specify the time in force for a particular order, it automatically reverts to a day order. So if you do not specify either you want a good till cancel or a good till day, it will automatically be reverted to a day order. So a day order is only valid for one day or for a single trading session. And if the order does not match, or if the order is not executed in that particular trading session, you will be required to enter that very same order again in the next trading session. Then we have a good till cancelled attribute. So what this does is it remains in the order book for a maximum of 30 days. So this is to specify that you want the order to remain valid. You want to buy securities at a specific price, or you want to sell them at a specified price, and you want that order to remain valid in the order book for a maximum of 30 days, unless you cancel the order before those 30 days are surpassed. So that is it when it comes to a good till cancelled order. Then you also have a good till day order. So this one you are just specifying the number of days that you want the order to be valid for, and it is cancelled upon expiry. So when it comes to these order attributes, especially when it comes to time in force, it allows the investor to be able to select the time frame in which they want their order to be valid for in the order book. When you are selecting this time frame, for example, you might be willing to buy securities at a particular price for today, or you're willing to sell securities at a particular price just for today, and you are not yet sure that maybe the next day you want a different price for that very same security. So this is when this time in force comes into play, to say you will be able to just indicate that no, I want this to be a day order, and if it does not match today this particular price, I might go on and put that very same that the order maybe at a different price uh, compared to the one I wanted the previous day. So it helps investors in terms of management of their assets and management of their risks. Moving on to tick size. So tick size is the minimum price movement set by the exchange on any security by which the order price and the quotation of a security can be altered. And it depends on the price level of that particular security. As you can see from the table that is outlined there, the price range for one security determines its tick size. So this is the minimum price movement that the security can have. And also, as highlighted here, we can see that as the price goes up, the tick size tends to also go up. So the tick size is kind of like a factor of the price range of that particular security. So it's within this range without specifying any currency or any whether you're trading on the VFX or ZSE, the the tick size will be determined by the price range. You also have what you call price spread, and it refers to the maximum percentage price movement allowable on a particular on a particular security in a single trading session. So this does not limit the investor. This does not limit the particular security to say uh, the price spread is only upwards or only downwards. It can be either both ways, upwards or downwards. And for securities that are listed on the Zimbabwe Stock Exchange, the maximum price spread is 15% for securities equal to or greater than one or greater than the equivalent of one USD cent. So the equivalent of one USD cent in our local currency, the 15% of that of that price will be the maximum uh, price spread on the security. And for VFX, it's 20% for securities equal to or greater than one USD cent. And for penny stocks, it's 100%. This is the maximum price that is that is allowable on that particular session for a security to move. Then when it comes to the matching criteria now of limit orders, we have what you call the price time priority. So price takes the first priority when it comes to matching, and time would then take priority given that price is the same for two different orders. So when it comes to price, the buys with the highest price have priority over buys with lower prices. And when it comes to sell orders, sales with lower prices also have priority over sales with higher prices when it comes to the price priority. So given the event that two orders are entered into the order book and they both have the same price, time will then take priority to say which order was entered in the order book initially, or which one was the first one to come or to be entered in the order book, and then time will take priority in terms of matching. As I said earlier when I was describing market orders, they always have priority over limit orders. So market orders will try to execute the whole or part of the order as soon as they are entered into the order book. Moving on to indices. Uh, just as a definition, an index is a statistical measure that tracks the performance of a defined group of securities. So we have different types of indices that we have, and they have different uses and different advantages of having these indices. So you find that for indices, one of the key reason for having indices, especially on an exchange, is for performance benchmarking. So you can use all these indices to measure the performance of a certain security, or to measure the performance of a certain management company, or a certain fund relative to that particular index. So these indices, they play a very crucial role in terms of risk management and asset allocation as well. And there are some individuals that are actually involved in what we call index investing, whereby you are just copying. For example, we have the ZSE Top 10 Index, where we are taking the top 10 companies that have the highest market capitalization on the exchange, and we are grouping them into that particular index and measuring their performance. So an investor might say, I want to do what is called index investing, whereby you're just investing the same proportion that is in that particular index on your own by copying that very same index. We also have an advantage of it having that it helps in market analysis and research. So when you're analyzing markets, it's always useful to have indices, as they can be used as a benchmark in terms of your analysis. So the types of indices that we have broad market indices, we have sector indices. Examples of sector indices that we have are the financials indices. We also have mining index and the agricultural index on the ZSE. These are just to mention a few of the indices that we have on the on the on the ZSE. So when it comes to these sector indices, how we group them to say these indices they fall in the same sector is we have what you call the global industry classification standard, where we use those globally allowed measures to say if a company is operating and most of its revenue is coming from this particular industry, it will fall in the ICT sector. Or if a company is in operation and most of its revenue is coming from mining, it goes on to the mining index. One of the other key indices that we have currently is the Zim National Stock Market Index, which tracks the performance of all the counters of all the securities that are listed on the Zimbabwe Stock Exchange, the Victoria Falls Stock Exchange, and FinSec. So it checks it checks the performance of all these counters. And on the VFX, we have the All Share Index, as well as the ZSE, we have the All Share Index, and some other indices that you can be able to find on our website as well, or upon request to the exchange. Moving on to market capitalization. So market capitalization is the total value of a company's outstanding shares on an exchange. When a company is issuing out new shares, especially in the primary market, and those shares that are being traded, the market cap is calculated using the price of all those shares that have been issued by a company. And what it does, it's a measure of the size and perceived value of a company, especially by the market. So the formula for calculating market capitalization, we use the current market price per share multiplied by the total number of outstanding shares for that particular company. And even when you are ranking different stock exchanges, you find that the total market capitalization can also be used because the uh, the size of an exchange can also be measured by the total market capitalization on that particular exchange. So you will be adding all the market cap for one company with the market cap of all the other companies that are listed on that particular exchange to calculate the total market capitalization for the whole exchange. And one of the other key ways of using the market capitalization is it's included as an index inclusion criteria. So when you are calculating indices, or when you are coming up with indices, we can use what we call the market capitalization weighting method, where indices are calculated by the market cap of that particular company as weights. for that particular index. When it comes to our statutory costs now, this will be my final slide before I hand over to my next colleague. So when it comes to the statutory costs involved in the buying and selling of securities on the exchange, we have two major legislation documents that cover the statutory costs. And the first document is the SI 104A of 2022, which governs or which outlines the trading costs that are associated with investing or buying and selling securities on the Zimbabwe Stock Exchange. And you also have SI 141 of 2023, and this one is primarily for the Victoria Falls Stock Exchange. We have different costs associated with the different exchanges, and but there are some of the other costs that are relatively constant they cut across board to all the exchanges. So we have costs like the broker's commission, your VAT on that brokerage commission. We have the SEXIM levy as the regulator. They also get a levy for on all the trades that happen on both exchanges. And we also have the ZSE or VFX levy. And what we call the Central Securities Depository Levy that is attributable to the depository for that particular security. I think this is all from my side, and I will be able to hand over to Rumbidzai. Thank you so much for listening and paying attention to this presentation. I look forward to more interactions, especially in the chat box and questions if there are any. Thank you very much. Over to you, Rumbidzai. No, not yet. Yeah, you're not yet audible, Rumbi.
Okay, am I audible?
Yes, Masha, we can hear you.
Okay, thank you. Thank you, everyone, for joining this webinar. And thanks to Rumbi, our moderator. So my area of specialty is depository services. So I'll be presenting on the CSD, focusing mainly on the clearing and settlement aspect of it. So for now, allow me to share my screen. Please confirm if my screen is visible from your end.
Yes, Masha, it is.
Okay, so thank you. So I'll be presenting on the CSD. CSD is basically short for Central Securities Depository. So at the moment, as the Zimbabwe Stock Exchange and the Victoria Falls Stock Exchange, we have an in-house depository, which is responsible for the clearing and settlement aspects of the trading cycle. So maybe basically as a starting point, I think I can start on the overview or the background of the depository. So the CSD, the in-house depository for the Zimbabwe Stock Exchange and Victoria Falls Stock Exchange was established in 2020, and it settles securities traded on both the ZSE markets and VFX markets. And the settlement model in use is called DVP2. So with the DVP2, we mean that securities are settled on gross basis, while the cash is settled on multilateral net basis. So gross settlement on securities and net settlement on the fund side. In the settlement cycle in use, we use the T+3 settlement cycle, where T is the date of execution or the trading date plus 3 business days. So it means that if a trade is executed today, the trade is expected to settle in is expected to settle in 3 days, which is Tuesday. A trade executed today will settle on Tuesday. So it means the buyer will get the securities on Tuesday, and the seller will get the proceeds on Tuesday. So my presentation outline. Firstly, I will look at the product that you offer as the depository, and maybe on the benefits of using a CSD, and I will move on to the key depository terminology, the technical terms that we use in the clearing and settlement of securities, and then to the CSD, frequently asked questions for the benefit of the investors. And lastly, I think I will look at the life cycle of the trade. So firstly, on the depository products, the depository is responsible for safekeeping of the securities, which it holds electronically, and it also eliminates the risk of the risk of the physical certificate that was used in the traditional model. So with the CSD, your securities are safe. And another thing that the depository does, the depository is responsible for clearing and settlement of trades. So clearing of the trades is done through the depository participants, which I will explain in the later slides. And the settlement is done by the depository, the CSD itself, together in conjunction with the central bank. Another depository product that we offer collateral services, where we allow the investors to use their eligible securities that they hold as collateral in cases where they want to take loans from the banks and so forth. And the depository is also responsible for registration of ownership. So what we do as the depository, we open and maintain an account for you, a securities account for you, which we term a CSD account. So that account, though opened by your depository participant, is maintained by the depository itself. And another function of the depository is the issuance of securities. In the cases of IPO, where new securities are issued, such shares are often issued through a CSD. Like in the case of the recently listed security, the Invictus, it was done through a CSD. It was done by the transfer sector, but the issuance of those securities are done through a CSD. Moving on to the next slide, which looks at the benefits of using a CSD. Here we are comparing the benefit of using a CSD against the traditional method, where there was no CSDs. So the first benefit is of efficient. Electronic record keeping and settlement processes are much faster and more efficient than the traditional paper-based methods. So here we are saying in terms of efficiency is increased with the use of a CSD. So for example, you can actually do your trading at the comfort of your home. There's no need for you to go and meet your broker. So you can do that. So as you can see that efficiency is a bit on the high side. And another aspect, another benefit of using a CSD is the issue of security. So with the CSDs, we have what we call segregation of accounts. So this means that your shares are safe and secure. Why? Because they are segregated from the accounts of your depository participants. For example, in the case that your depository participant goes out of business, your securities are safe and secure because they are held in a segregated account, which is different from the one of your what? Of your depository participant. And another aspect is to look at the reduction of risk. So with a CSD, the reduction of there is a reduction of risk, like the theft, unlike in the case where we used to trade the physical share certificates. Now we are trading online, we are trading electronically. So there's reduction of risk, such as that of theft, which I've mentioned earlier. And also another benefit of using a CSD is that CSDs, they provide a standardized framework for the trading and settlement of securities. So there's a standardized process that we follow as the CSDs from the day of execution to the day of settlement. So that alone is a benefit on its own. Why? Because by standardizing, we mean that even if your clearing agent is participant A or participant B, then the clearing and settlement of the securities is standardized. And moving on to the key depository terminology, I think it's vital to first define what a CSD is. So by definition, a CSD can be viewed as a financial institution which provides safekeeping, registration, and settlement of securities. That's what we call it, a CSD. I think I've explained in the previous slides about safekeeping and registration of issues of securities. So another aspect that is important to note is a depository participant, which is also a financial institution that acts as an intermediary between depository and its client. And with the model that we use as the Zimbabwe Stock Exchange, we have categorized the depository participants into three groups. The first group, which consists of custodians, which are also called depository participants. And the second group consists of settlement banks, then transfer secretary. So who is the custodian? So the custodian is responsible for registration on behalf of the depository. It is also responsible for clearing aspect of it of the trading cycle. And moving on to the settlement banks, this is where the movement of cash to the sellers and from the buyers takes place. And the transfer secretary is the registrar, who is the link between the issuer or the company that is listed on the stock exchange and the depository. So the issuer and the depository communicates through the transfer secretary. And currently, on the Zimbabwean on our capital market ecosystem, we have three of these. We have the COPSEV registrars, we have the first transfer secretaries, and the ZB transfer secretaries. Moving on to the next slide, here I'll look at the CSD investor account. So what is a CSD investor account? This is a digital account where securities are held in electronic form. And to open this securities account, you approach your broker or your depository or any depository participant of your choice. Currently, we have over 10 such depository participants, which can be accessed through our website. I will share the link at the end of this presentation. So you approach your depository participant or a broker if you want to open one. If you want to open an investor CSD account, so that account there is a certain code that is allocated to you. So that's what you call an investor CSD account. Moving on to another term, which the term dematerialization. So with dematerialization is basically the process of converting the physical certificates into electronic form, and is done through your depository participant. Say you have physical certificates of, let's say, Econet, and you want to trade them. So you can, with the current model or in the current ecosystem, we cannot trade the physical certificates. You need to convert the physical certificates first to form an electronic record, which will be carried by the depository participant. So the first step in dematerializing your shares is you approach your custodian. They assist you in opening your CSD investor account if you don't have one, and after that, they then capture what's on the certificates, and then send the certificates to the transfer secretary for validation. After the transfer secretary validates the certificates, then it sends them to the depository for final authorization. So after that, your shares will be available for trading, and you can trade them anytime, anywhere. So another term that is common in CSDs is rematerialization. Basically, rematerialization is the direct opposite of dematerialization. This is the process of converting electronic records into physical certificates. So this, however, we don't recommend the investors to take this route. Why? Because of the benefits that I've highlighted in the previous slides. So the process of rematerialization, it starts with your depository participant or the custodian, then in this case, it comes to the depository, then from the depository to the transfer secretary, and you can collect your physical certificate from your depository participant. And another term that is worth discussing is clearing. So clearing, as I have mentioned earlier, is done by the depository participants. In this case, it's done by the custodians. So during clearing, the broker, the custodian, will be responsible for checking the information on the broker's note against what's on the client's instruction. If that information is matching, then the trade is good for settlement. So that is what you call clearing. It's a reconciliation of some sort, and is done by the depository participants together with the depository. And after clearing, then comes settlement, which is the final and irrevocable. So once a clearing is in order, once all the trades and once all the orders are affirmed, then we move on to the next stage, which is the final one, which we term settlement. So at settlement, this is where the buyers receive the securities, and where the sellers receive the proceeds from the trade. And this is done by the CSD, and in conjunction with the central bank. So the CSD is responsible for executing the securities leg, whilst the money or the fund settlement leg is executed by the Reserve Bank, and the buyers will start to receive their funds. And usually this day, in the capital markets, we term it T+3. Why? Because we are currently using the T+3 settlement cycle. And another term that I've been mentioning a lot is the settlement cycle. What is the settlement cycle? So the settlement cycle is the period between T+0 and the T+3, between the execution time and the settlement time. And that period that is where clearing takes place between T+0 and T+3. And another term that we may come across in the depository field is a pledge. What is a pledge? Basically, pledging is the process of using securities as collateral for a loan. As I have mentioned in the previous slides, that currently we have that pledge facility as the depository. You approach your bank, your credit, they give you a loan. So where they want collateral, you can say, I own so and so shares which are listed on the Zimbabwe Stock Exchange. Can I use them as a pledge? Then you come to us, we validate that. Then after that validation, we give a confirmation that so and so is a legitimate holder of these shares, and then the bank can use your shares based on our confirmation as collateral. Then moving on to frequently asked questions in CSDs. So you can ask as a starting point. The first question, the frequently asked question, is how do I open in a CSD investor account? So opening a CSD investor account is very simple. You have two options. You have many options. So the first one is you can open a CSD account through a depository participant. You approach a depository participant of your choice, then they can open a CSD account for you. Or alternatively, you can do it on your own. You can download one of our applications which are available on Play Store, which is the VFEX Direct and the ZTC Direct. So using these applications, you can open a CSD account at the comfort of your home. Moving on to the benefits of having a CSD account, the benefits include convenience, security, and reduced paperwork. I think I have touched on this in the previous slides. And I said that the depositories where you deposit your shares, then someone may be wondering what is the difference between a CSD and our normal bank account. So these accounts, the way they operate, they are similar in a sense. However, the major difference between the two is that a CSD investor account is specifically for holding the shares and is held by the depository, whilst your bank account is for holding your funds and is held by our conventional banks. And another question that is frequently asked is that can I pledge my securities for a loan? Yes, you can pledge them as collateral for a loan, and all the shares which are listed on the ZTC, they are eligible to act as collateral for a loan. And what happens if my depository participant goes out of business? The securities will be transferred to another depository participant of your choice. So let's say your depository participant is, for some reasons, they've gone out of business. Your shares are safe because, as I've mentioned earlier, that there is segregation between your shares and the account of the depository participant. So in the case that your depository participant goes out of business, there's no need to worry. Why? Because you simply be allocated another depository participant And moving on to another question, can I access my CSD investor account online? Yes, definitely. We can access them through our online applications, which I've explained on in the previous slides, called the ZSE Direct app and the VFX Direct app. So using these applications, it's easier for our investors now to access their investor CSD accounts online. Another question: can I open a joint CSD investor account? Yes. If you wish to open a joint CSD account, what you simply do is you approach your depository participants, you notify them of your intention, then they outline the requirements for a joint account. After that, your account is good to go. You can now start trading. Can I open multiple CSD investor accounts? Yes, it's possible for investors to open more than one CSD account for the reasons better known to them. For you can open any multiple investor CSD accounts under one depository participant. Yes, it's possible. You need to notify your depository participant, or you can open an multiple investor accounts under different custodians or depository participants. However, the only difference that will be there in their account is your suffix. Your account will be the same. Will be the same. The only difference will be the first one. Your main account will be dash 0001, and these other accounts that you have opened with another deposit participants will be referred to as your sub accounts, but they will be under your name, and you will be having full control of these accounts. And to get more information about the depository, you visit our website, which is the www.zsc.co.zw, and on that you click on the tab where it's written depository. There you can access everything that you may need about the depository. And maybe before I conclude my presentation, I think it's important to highlight the life cycle of a trade to investors. So the life cycle of a trade starts with execution. So execution is done by your broker, or you can exercise this part on your own using our direct applications, which I've mentioned earlier, the ZSC Direct and the VFX Direct app. So at execution is done at T+0, and after execution, the clearing part starts. So the clearing part starts just after execution. After the post close, then clearing aspect jumps in. So the clearing aspect, as I've mentioned earlier, is done by your depository participant together with depository. So that's where the depository jumps in at clearing. Then at T+2, clearing is still taking place. And at T+3, settlement happens. And we say DVP is complete. By DVP, it's delivered versus payment. It's the mechanism that is used in settlements such that the movement of funds and the movement of securities happens simultaneously so that we are so that the investors are safe, and that there is no risk of getting your shares of the buyers getting the shares without the sellers receiving the funds. So that is what you call DVP. And as I've mentioned earlier, as the Zimbabwe ZSE and the VFX depository, we use DVP model number 2. We have model 1, we have model 2, and we have model 3. So ours is model 2, where we settle the securities on gross basis and the funds on multilateral net basis. With DVP1, both the securities and the funds are settled on net basis. On DVP1, they are settled on gross basis, and on DVP3, both the funds and the securities are settled on net basis. And DVP3 is more advanced, and we look forward to adopting that maybe in future. So for the benefit of our investors and our participants. And after settlement, there is the phase that we call post-settlement. And post-settlement usually is the time which is after T+3. This is what we term post-settlement of the trade, of the life cycle of a trade. So I think that's it from me. Thank you all for your time and attention. I leave this opportunity to our moderator, Rumbita Eminyai. Thank you.
Thank you so much, Marshall, for showing a strong understanding of your presentation. I hope everyone had a great time from the depository, the VFX markets, and the ZSE markets. So I'm going to take this time to take questions if there's anyone with a question. The only question that I saw in the chat box, let me read that one out. Okay, there's a question in the chat box from Murau Challenge Takuzwa, and it reads, there are other companies similar to CoverLink that offer a service where they invest client monies collected from insurance contracts on their behalf. It seems this option would appeal primarily to those with a desire to invest, but who actually want to manage their own investments. As someone new to investing, what steps would you recommend I take to get started investing on my own? So I'm going to give this question to Takuzo to answer on the ZSE side, and then to Medjuri as well for the VFEX.
All right, thank you so much, Rombi. So essentially what we are saying is taking into consideration the company that you mentioned, that it pulls investor funds, especially from insurance contracts, and it invests those funds on behalf of the investors. So I think the primary consideration, especially when you're investing by yourself, is to understand the framework, or to understand the model of any particular investment that you are making. So you need to understand the framework, you need to understand the regulation and the types of securities that you are investing in. And as highlighted earlier on, to say we have different kinds of securities that are listed on the exchange, including your equity instruments, ETFs, real estate investment trusts, and depository receipts. So all these, they are kind of like ways in which an investor can pool their funds and invest in these particular securities. So just as a recommendation, I would suggest for you to start investing on your own. You need to understand the environment that you are operating in. You need to understand the basics of the actual underlying securities that you are investing in. You need to understand if you are investing in a certain company, how does that company make money? How do they go about their operations? What is the structure of that company, the corporate governance? Is are you comfortable enough to understand all the members or the decision makers in that particular organization, including the board of directors, because they also play a very important role, a very crucial role in terms of the the going concern of that very same organization. I think it is also a very much important to use what you call technical analysis in terms of analyzing your investments. So the part that I mentioned earlier is kind of like the fundamental part of investing. Then the technical part of it, you are considering historical data or historical prices, volumes, and values traded to make an informed decision on the investments that you'll be making. So I think a combination of these two will come a long way in helping an investor um, understand and make better decisions in terms of their investing. Thank you so much.
Thank you so much, Takudzwa. I'm going to give this opportunity to Mejuri as well. She has something to add.
Okay, thanks, Lumpi. I just wanted to add on to what Takuzo said. I totally agree. For you to start investing on your own, you have to understand the fundamental side and also the technical side of things. And as a personal recommendation, I don't think it would be wise for an individual investor to just go guns blazing and start investing on your own. I think it's key for you to consult, to ask for those who cannot afford investment advisors or asset managers. You can make use of your broker to inquire on anything that you might need before you actually go on and take a step to invest. Usually, our stockbrokers, they have research departments, they have analysis that they do on a daily basis, on a monthly basis, on an annual basis. So it's key for you as an individual investor wants to invest on their own account to actually be in consultation with your broker before you make this investment decision. And now, when you come to a point where you understand these fundamentals and technical aspects, then you can act independently and make your own decisions when investing.
Thank you so much, Mejuri and Takudzwa. I hope you have been answered. Do we have anyone else with a question before we close our session?
Thanks, Lumbi. I had seen a question earlier from Innocent who was asking he wants to register on to and start trading on VFX. So, like what Mashi and Takuzo were mentioning throughout their presentations, we have mobile trading platforms for both ZSE and VFX where you can register. I have just shared
Thank you so much, Marjorie. I had missed that question. We have another question in the chat box from Nelson Murewa. Are you going to share the presentations with us? Yes, most definitely. We're going to share the presentations with you. Maybe end of day today or tomorrow. Expect the presentations to be sent to your emails, the ones that you have registered with. Do we have any other questions from the crowd? Okay, I got another question from Murau Takudzwa. Are there any online applications that can help strengthen one's understanding of security fundamentals to further knowledge in this area? Additionally, when is the next meeting for this group? I have found our discussions thus far to be quite helpful for expanding my learning. I'll leave this question to Marjorie to answer.
Thanks, Kambizai, and thanks, Takuza, for your question. Yes, we do have online applications that can help you understand more about the capital markets. Let me quickly just send the link to the ZSE Training Institute, where you can enroll and get to know a bit more about the capital markets. And it's actually free of charge. You can enroll for these courses. At the end of each module, you can take a short quiz to just test out your understanding if you have grasped the concepts. And as for the next meeting for this group, whenever we hold these webinars, we post on our social media platforms. So maybe you have to subscribe to our social media platforms for you to be up to date with any upcoming training events that we have online. So on our social media platforms, it's Zimbabwe Stock Exchange, and that's on Instagram, X, Facebook, and LinkedIn. And for on the same social media platforms as well, you can follow the account Victoria Falls Stock Exchange as well to be up to date with any upcoming events.
Thank you so much, Marjorie, for taking up that question. Do we have any more questions? Thank you so much. If we don't have any other questions, I would like to thank everyone who has taken their time to participate in this webinar. We hope to see you next time. And just check your emails for the presentations that we're going to send. Thank you so much. Have a great day.
Thank you. Thank you.